So high-low foods, high-low foods. So our first note is here on November the 1st, and it's a 300,000 6-month 5% note. Now, first of all, we're seeing that it is expressed in terms of months, 6-month note. And it's a 6-month note. And so that means all of our calculations would be in months. If they express it in days, then our calculation is in days. Okay. So it's a 6-month note. So on November the 1st, we're going to record the note, debit notes receivable, credit sales, $300,000. And you know how we don't include any interest at the time we record it? The interest doesn't happen until either A, we cross a year end or month end, or B, the note matures and we're either collecting it or moving it out of notes receivable. Okay. So here on November the 1st, we're recording the note. Now I'm going to jump ahead a little bit. On December 31st, okay, one of the entries is to accrue the interest on the no extra foods note. Okay, so on December 31st, what we have to do is accrue interest from November 1st to December 31st. Okay, chapter 3, accruals. Accrue the interest. Now the note is going to be outstanding from November 1st to December 31st. So it's all in November, all of December. Now it's a 6-month note, so our calculations are going to be in months. So 2 of 12 months, not exact number of days. Okay, we'll use what they give us in the problem. Now in real life, it's usually exact number of days, but anyways, here it's expressed in months, so we go with months. Okay, so 2 months divided by 12. Okay, the interest rate is 5% annually. That's why we're prorating it, 2 of 12 months, times $300,000. Okay, it's $2,500. Now, on May the 1st, we collected the maturity of no extra foods. So I'm just going to jump down to May 1st here. So on May the 1st, we collected the note. So how much cash did we receive? Well, the 300,000 times the 5% for 6 of 12 months, half a year. Okay, and again, the calculation is in months because the problem was presented to us in months. So the cash we receive is $307,500. Now we accrued $2,500 here in the interest receivable, so that's received. So we're going to empty that down here. And then the interest revenue is the balance, $5,000. So 2 months was for last year. So 4 of 12 months, or $5,000 is for this year's revenue. Okay, so the only time you accrue is when you cross a year end or month end, or when a note matures. Okay, that's the only time you have to record the interest. So the other journal entry is on December the 5th, going back up. I tried to color code these. So on December the 5th, it says we recorded our Visa, our credit card sales, 4% fee. So you can use bank charges expense, or I think in the textbook they use Visa charges expense, something like that, credit card expense. So I'm happy with either. Bank charges expense is the traditional one that they use. Some companies will use bank or Visa credit card discount expense or something, but whatever the textbook says, or bank charges expense, is perfectly acceptable. Okay. And so the sale was $30,000. The bank withholds 4%, $1,200 on that transaction. And then the cash that we get is $28,800. Now on the 31st, we have adjusting entry with regards to our bad debts expense. Okay. And if you read the question, it says that the aging analysis, or here, the bad debts expense is based on an aging of accounts receivable. So they're aging accounts receivable, effectively telling us to take a percentage of accounts receivable. So this is the balance sheet approach, okay? Which means we have to take into consideration the balance in the allowance for doubtful accounts. The amount that we calculate under this method should be the ending balance in the allowance for doubtful accounts. So looking here, you can see that the aging indicates that $154,000 of the accounts receivable will not be collected. Okay, 154 will not be collected. Now, prior to this adjustment, it says, prior to this adjustment, just looking for my water. Prior to this adjustment, the balance in the account was 140. This is the aging of accounts receivable, or percentage of receivables method. The balance that we want in our allowance for doubtful accounts is 154. It's currently 140. So we have to top it up. We have to add $14,000 to it to bring it up to 154. Okay. So we debit bad debts expense, credit the allowance for doubtful accounts, always the same journal entry, always the same. So we did no extra foods. The next note that we see here is the one that's in orange. And as I said, I did try to color code these. So in orange, we have Sherwood Market, okay? And on the 15th, we received a 60-day, so we're gonna calculate in days, 60-day 8% note from Sherwood Market. So we'll debit accounts, notes receivable. And it's interesting here, it's saying on account, which means that we probably got them to sign a note because they weren't paying an accounts receivable. So this is going to come out of accounts receivable. That's on May the 15th. Now, if we jump to July 14th, it says they collected the maturity. They collected the maturity on July 14th. So here we are, July 14th. We've got a debit to cash, which is going to be the 7,200. It's a 60-day note, so 60 divided by 365 times 8%. 8% is an annual rate, which is why we need to prorate it. Okay, our note is only outstanding for 60 of the 365 days in a year. So our debit to cash is going to be 7,200 plus the 94.68 interest. We remove the note from notes receivable and recognize the interest. Okay. So on June 23rd, in blue, the note in blue, we've got Meadow Foods. They received, here we are, a 30-day 6% note. Okay, 18,000. And you'll notice we're not calculating the interest on the day we receive the note, right? No interest is calculated until the note matures or until we cross a month end or year end. Okay, so we just record it here. Now that's on June 23rd. So on July 23rd, it says right here, Meadow Foods dishonored the note. They failed to pay. So we converted the note to accounts receivable. So here we are. We're going to take it out of notes receivable and we're putting it into accounts receivable. Okay. And you'll notice that we're putting it in accounts receivable with the face value plus the interest, Why are we adding the interest? Well, we've got a contract that says they owe us that $18.77, right? Per contract. Now, Meadows actually, on the 5th, Meadows actually, in blue here. Oh, it's only letting me go a page at a time. Can't cross over a page. Okay, so here we are on the 5th. Okay, and we collected in full. So we got our cash of 18,000. And we take it out of accounts receivable, 18,000 plus interest, $18,088.77. Okay. Urban provisions on November the 16th. We lent 25,000 to urban provisions on the 16th. And this is actually a darker blue. Here we are on the 16th and 31st. So this is a 120-day note. So we'll calculate it in days. So it's a $25,000 note and we loan the money. So our cash goes down because we gave them cash. On December 31st, what we have to do is accrue interest on the urban provisions note. So it is a 120-day note, but from November 16th to December 31st, it's only outstanding for 45 days. How do I get 45 days? Well, for November, I've got 14 more days. So it's November 16th today. So I start counting from 17, 18, 19, 20, all the way up to 30. There's 30 days in November. So 30 minus 16 is 14 days. So 14 days remain in November. And then all of December, which is 31 days. And if I sum those two, I get 45 days. So my calculation is 45 of 365 days times the 8% times the principal. So I'm going to accrue $246.57. Okay, are there any questions on these notes? I did try to color code them. So we jumped around a bit so we could, follow the logic of the whole note all the way through. Any questions on the notes? Okay. In the next problem, we've got a few more notes here. Here we are. For Seaview properties. For Seaview properties. Okay. So record the following 4 journal entries for Seaview properties. So there's 4 notes that we recorded for Seaview. Three notes for Seaview. So the first one, October the 1st, is so the first one, October the 1st, we've got Lazarus. Okay, and that was, we loaned cash, so our cash went down. The second one was we sold goods. Okay, we sold goods. And so our credit goes to sales. And then the third one came out of accounts receivable. It was on account. So our credit came out of accounts receivable. And in this problem, one note is expressed in annual terms. One note is expressed in daily terms, and then the other is expressed in monthly terms. Okay, so our calculation will be in kind. Right? If it's expressed in annual terms, we'll do the calculation in annual terms. If it's expressed in daily, we do the calculation daily. If it's expressed monthly, we do the calculation monthly. So the point here is to do an interest accrual. So our journal entry to accrue the interest is going to be debit interest receivable, credit interest revenue. The tricky part is how much. And what I did here is I kept all 3 notes separate, just so you could see how I arrived at the number. Okay, so for Lazarus is expressed in annual terms. We needed to accrue for 2 months, so we multiplied it by 2/12. For high water, we had to calculate it interest based on, it's to November 30th. So we're going November 3rd to November 30th, 27 days. Okay, so we get $9.36. And then for STM, it's the 16th, so half a month. Okay, half a month. So half a month. So STM, 0.5 months divided by 12 gives us $3.67 to accrue. So in total, our credit to interest revenue is $159.69. So the point of this one was, accruing the interest under daily monthly or annually. Any questions? Any questions? Okay, let's look at one more then. If we turn the page, here, the last one is flipping over to accounts receivable. And we've got Ali Kassar Landscaping. Ali Kassar Landscaping. Okay. So, Ali Kassar Landscaping. So they give us some details. Balance of accounts receivable, balance for the allowance for doubtful accounts. During the year, we had some write-offs, okay, uncollectible amounts and written off, and our sales revenue for the year, and our credit sales, as well as our cash collections. So first of all, it asks us to journalize the credit sales. So to journalize the credit sales, debit accounts receivable, credit sales. Okay. And I call that just A. So B then says, what about the cash collections on account? Well, the cash collections, they tell us they received $413,600. So we're going to debit cash, credit accounts receivable, $413,600. That was given to us. C, it says write off. Record the write-offs. That's the $4,290. So we have a standard journal entry for that. We take them out of accounts receivable. So we're going to credit accounts receivable. And we also take them out of the allowance for doubtful accounts. So we're going to reduce the allowance for doubtful accounts, $4,290. Okay. Now D, 1D says record the bad debt expense based on 1% of credit sales. So that is the income statement or percentage of sales approach. So we have a standard journal entry for that. It's always debit, bad debts expense, credit, the allowance for doubtful accounts, right? It's always the same journal entry. Debit, bad debts expense, credit, the allowance for doubtful accounts. And I get 4,224 by taking $422,400 times 1%. And that is the credit sales that was given to us in the problem. So those are all our standard journal entries, all our basic journal entries. Any questions on these so far? So in part 2, it asks us to prepare a T account for these two. And my T account is not so easy to see here. It kind of got buried. See if I can't draw a T account here. Is it going to let me use the pen without doing all that? Okay, well, let's grab the pen. So here's accounts receivable right here. There's the line, not a very straight one at that, is it? Here. So there's the line. And for allowance for doubtful accounts, here's my T, goes straight here. And then it goes down here. Oh, that's just awful, isn't it? That's just awful. Okay, so let's close that. So you can kind of see here. So you can see here, here's accounts receivable. There's my really squiggly T account. I should have used that straight line function. So our opening was 38.5. It was given to us. Our credit sales, debit accounts receivable, credit sales was 422. We subtracted the payments on account for 13, and we also had a write-off, 42.90. So the closing balance is $43,010. The allowance for doubtful accounts was given to us was $2,310. We did write-offs, which gave us, interestingly, a subtotal of a debit $1,980. Of a debit $1,980. So it went into a debit balance here. That's okay. It's an estimate. It's an estimate over time, right? It's an estimate over time, right? And then after we post our entry here from 1D, our provision for bad debts at the end of the year from 1D is 4224. So the closing balance for the allowance would be 2244. That's the percentage of sales method. Percentage of sales method. So now number 3 says calculate the balance in the allowance for doubtful accounts based on aging of accounts receivable. Now they're saying calculate the balance of the allowance for doubtful accounts because under the aging method of accounts receivable, the uncollectible portion should be the ending balance in the allowance. So what we're going to do is assume that we haven't recorded the percentage of sales, okay? Because it's either or. You either do the percentage of receivables method or you do the percentage of sales method. So if we did the percentage of sales method, they're asking what would be the ending balance in the allowance for doubtful accounts? Well, we know under the percentage of receivables method, okay, the amount that we calculate as uncollectible, and in this case here, $2,750. Under the percentage of receivables method, that needs to be the ending balance of the allowance for doubtful accounts. That needs to be the ending balance, the allowance for doubtful accounts. So 3 is 2,750. Now 4 says, what's our journal entry? Let's say, what is our journal entry, assuming the entry in 1D has not been made? So we're going to bad debts expense credit the allowance for doubtful accounts. Okay, but what we need to do in that case is we wouldn't have 422 here. Okay, what we would have here is we wouldn't have 4224 here. What we want right here is 2750. We want the ending balance to be the uncollectible portion. In order to achieve that, we've got a debit balance of 1980, which means that to achieve an ending credit balance of 2750, we're going to have to debit bad debts expense, credit the allowance for doubtful accounts, $4,730. So here's the 2,750 right there. And this 4,730 is down here. Okay, so what we had to do was credit this $4,730 to bring this balance up to the uncollectible portion. Finally, they say, what does it look like on the balance sheet? Well, on the balance sheet, what we've got is our assets, then current assets. We've got accounts receivable. The balance is 43010. That's from here. Our allowance for doubtful accounts is, I assumed, based on 3/27/30, which means our net book value is $40,260. That's what it's going to look like on the balance sheet. That's what they're asking. What's the balance sheet presentation? What's it look like? Any questions on this?